Hello, everyone, and welcome to another one of our Macro Mondays. A lot happened in the markets last week, so let's unpack some of the events that may have impacted the stock market moves and bond moves last week specifically. So the Federal Reserve remained unchanged in their interest rates. They have not lowered rates yet, and they're looking to potentially do a rate cut in September. The Feds, from the commentary perspective, seems to think that the economy is in pretty good shape. The commentary don't seem too worried, but talking quite dovishly around rate cuts as they observe that inflation is moderating and the labour market is softening. The confusing part for some of the veterans in the market, like Jeffrey Gunlock, would be that, we're observing that the economy is slowing extremely quickly and perhaps you should actually have cut today. So I guess we've opened the door to a potential emergency cut between now and September, although I'd say it's pretty unlikely. The most likely outcome is that September there'll be a rate cut in the US, which would actually help New Zealand because I believe the RBNZ are not lowering rates partly because the US hasn't yet, and that'll actually negatively impact the dollar. It would not be great for the New Zealand dollar if we were to cut rates first, most likely. In terms of the market and how the market reacted to a bunch of earnings, there were so many earnings reports last week, which created a lot of news, a lot of liquidity, and a lot of volatility in stock prices as market participants reacted to earnings. But also, there was a consistent move up in bonds in terms of the value of bonds going up, because as interest rates drop, the value of bonds goes up. And what we also observe is that across the board of the stock market, the IWM, which is the Russell 2000, performed the worst. Then the least was the Dow Jones Industrial Average, the DIA, which is an ETF, underperformed the least out of that group. Ultimately, though, stocks performed pretty poorly last week, and the IWM was no exception, despite having outperformed the S&P 500 over the last month. What does that tell you? Well, it seems that the bond market is saying, hey, there's going to be rate cuts and there's most likely going to be a recession. It's definitely moving with a lot of vigor right now. And then I would say that stocks are kind of signaling the same thing. And typically the stock market is the last to see a recession coming. For some reason, the stock market often gets baited into these long drawn out bear market rallies that then dissipate when the actual recession hits. And from a valuation perspective, especially the NASDAQ and the S&P 500, historically high valuations. So we could just be seeing a rotation into bonds because a lot of investors are seeing that interest rates are likely going to be coming down sharply and shortly. But it also could be a slight acknowledgement that a weak economy is not good for equities. The IWM, so this is the Russell 2000. There's been a lot of chatter around small and mid caps being underloved for the last 2 or 3 years. And is it now time for them to catch up? And is there a rotation into these names? I think from a valuation perspective, on a relative basis, small and mid cap has basically never been cheaper. But even if interest rates come down and the cost of borrowing goes down, it doesn't necessarily mean these smaller companies have borrowers that are willing to lend them money. And some of them may get affected if there was a recession. Ultimately, I think time will tell. However, if the equity market in general is volatile, of course the small and mid caps will be volatile too. That could create some opportunities. I'm not sure, but I definitely don't think they're immune to volatility just because interest rates are going down, and that in theory helps them. So still one to watch. Let's move on. So oil. I think it's a bit of a wild card at the moment. There's been so much geopolitical tension, yet the price has been relatively stable and, if anything, quite weak. From a traditional perspective, you'd go, oh, well, oil's been acting weak. That could be a demand problem. It could be a demand problem. That would be consistent with a view on a recession. However, with the geopolitical environment that we have now, it feels like almost anything could happen. However, until something does happen, if the economy continues to slow, then most likely oil stays relatively muted and potentially goes lower. But it seems like an absolute wild card in this market because it's almost being overlooked because there's so much other information going on right now. But the price action itself really kind of makes you wonder. This is quite a big one. So Buffett dumps over 50% of his Apple position, as well as selling a bunch of Bank of America shares as well. Super interesting. Obviously, we have discussed in the past that larger companies are the ones that have seen all the equity inflows, have seen all the appreciation in their stock prices, and have become pretty expensive from a fundamental perspective. So why is Buffett dumping his position? He's not the sort of guy that dumps his position because a stock has become a little bit too expensive and then will be buying next week when the price drops. That's not his style. He buys businesses. It's really interesting that they're deleveraging their position in Apple by so much, but it could be just one of those things where Buffett's coming to the end of his career, them deleveraging their position for the next generation, for the succession of Berkshire, makes a lot of sense. And ultimately, with someone that has such an amazing track record, to come into the last couple of years and risk your track record by keeping these large positions open, maybe something that Buffett doesn't want to do. So it'll be really interesting to see how this unfolds and when he discusses the reasoning behind dumping such a large part of his portfolio. It'll be really interesting to hear what he has to say specifically about that. So I would not take it with a grain of salt. Buffett does not dump his positions on a whim, but it may not have that much to do with the price or the stock market right now. It may have more of a personal aspect to it, where the rational thing to do here, if you're Buffett and you have such an amazing track record, would be to potentially take some risk off the table and make sure that the successor has a lot of cash to play with as they build their own legacy. In terms of yields were at 4.2, 4.3 when we spoke last week when we were doing the last Macro Mondays. I thought I had to put it in again, especially it's at 3.872 on the 2-year Treasury. That's a huge move down. So the bond market is going, well, rates are falling and they're going to be falling a lot quicker than the Fed is signaling. So I think what the bond market is telling everyone is saying, hey, I think the Fed's late. I think the Fed's going to have to cut rates a whole lot faster than they're saying they're going to. And they may even have to capitulate and do an emergency cut in the market. It's saying the Fed's behind. The Fed needs to cut rates. They probably should have cut rates today or last week when the meeting was. So I think there's a lot going on right now, and there's always lots going on in the market. We're currently going to go through a phase of seeing what all of the tightening is actually going to do to the economy, because there is a very large lag between when you start raising rates and then you start actually seeing the effects. Not to mention that we've also had so much government spending across the globe, and in a lot of places around the world, that is looking like it's slowing down. So that will also impact GDP broadly in countries that were spending a lot through their government. So we'll keep tracking the yields. It's an interesting story right now. I'm very fascinated by the bond market during this time. The bond market seems to be awake and looking to make some moves. So we'll see what happens next week. As always, this podcast is just for information purposes only. There is no financial advice, buy, sell, or hold recommendations in this podcast. And we look forward to seeing you next week. Have a great one.